Jerome Powell comes in more hawkish than expected. That's coming up on 3 Minutes on Markets and Money. Yesterday morning, we discussed on 3 Minutes on Markets and Money that very likely the Fed would be much more hawkish in their statement following the announcement yesterday to ensure that the message was not misinterpreted as Powell's speech was back when he did it last week at the Brookings Institution that caused that 3.1% spike in the day on this whole idea that the Fed was close to pivoting. And we said that he'd be much more deliberate in his language, and that's exactly what happened yesterday. The Fed did hike rates by 50 basis points, but most importantly, Jerome Powell said, we are going to hike rates. In fact, we're likely going to hike rates more than expected, putting a terminal rate now at about 5.1% next year. So that suggests at least 3 more rate hikes potentially next year. And we're going to leave them there for the year. We're not going to be pivoting. And he was very clear about this idea that there was no pivot coming. That disappointed markets. Markets sold off yesterday, holding the 20-day moving average. Now, overnight, markets have been kind of digesting this whole speech from the Federal Reserve, realizing that the Fed is very intent on creating higher unemployment, creating some pain in the economy in order to bring inflation down. And this morning, markets are going to open weaker, down about 1%. Now, this is going to bring a challenge back to this 100-day moving average that we've now been holding on to ever since really November the 8th. If we go back to October the 15th, the market rallied to the 100-day moving average, failed, came down, tested the 20-day moving average, then moved above it, and we've been above this 100-day moving average now, trapped between the 100-day and the 200-day moving average. So this whole range of the market remains fairly confined here at the point between a very tight window. And at this point, we haven't really made a move one direction or the other. So again, what will be most important today? And now remember, tomorrow we have options expiration, $3.2 trillion of options expiration. So this market can be anywhere over the next 2 days as people are rebalancing portfolios, of course, for the end of the year, but also hedging off on these trades one way or the other based on their options contracts. So if this market breaks to the downside, there is some support right here at the 50-day moving average at about 3,900 on the S&P. If we're able to break back above the 200-day moving average, 4150 looks like the most reasonable target in the short term between now and year end. Pretty decent ranges in both directions. But as we've said before, we're moving into the end of the year. Inmates are going to run the asylum, very light trading volume. So a break out of this trading range in one direction or the other could be fairly large. We'll see what happens. But again, you want to be somewhat prepared. Again, we've talked about not chasing the CPI numbers and the Fed speeches. That proved to be decent advice at this point. Maintain some risk off positioning at the moment. A little bit more cash, be a little bit more hedged, because again, I really have no idea what's going to happen in this market over the next 2 to 3 weeks as we go into the end of the year. So being a little bit more risk averse may actually be the best case to be right now. That's 3 Minutes on Markets and Money. See you back here on Monday.